All right, welcome everyone. Day 2 of the advanced trading course. Today we're going to go over risk management. Okay, so picking up right where we left off yesterday, what separates the good traders from the bad traders? Ultimately, it's risk management. Your ability to manage risk is uh, the most fundamental concept of day trading that you need to understand. Managing risk is number one. So that's why we're talking about this so early in these classes, because even more important than picking the right stocks and choosing the right patterns is going to be your ability to manage risk. Okay, this is what's going to separate the winners from the losers. If you're able to manage your risk, you have a much better chance at becoming a successful trader. Okay, so we talked about this a little bit yesterday, but using proper risk management principles, we can actually be right less than half the time and still make money. Okay, so when we get that kind of profit loss ratio where we can make money and only be right 50% of the time, it actually takes a lot of the pressure off of us to pick the right stock every single time we take a trade, right? Because we know we're using a profit loss ratio where we can be wrong a lot and still make money. We're putting the statistics in our favor, right? We're putting the odds in our favor to be a successful trader. And as we know, the statistics for being a successful trader are not very good. We want to do everything we can to boost those numbers, right? A lot of new traders don't make it past the first year, and I think the biggest reason is because, well, they're not managing their risk properly. But the learning curve for trading is steep. Okay, and it's really hard. It takes time. And if you're taking losses during your first year back to back to back to back, you're simply not going to survive in the market long enough to learn. Okay, so one of the things that you want to understand is that right now we're focusing on teaching you survival skills in the market so you can survive for your first 6 months without blowing up your account, right? Anything I can do to help avoid seeing any of my students have a day where they lose $4,000 or $5,000, I mean, I'm going to do it, right? Because those days happen to me too many times. I had a period of probably 6 months where I had winning streaks where I made money, but then I would have a bad day. And on my bad days, I would lose a huge chunk of change. So it would be like 10 little steps forward and then one huge step back, and then 10 more little steps forward and then another big step back. And I kept trading on that pattern for a long time until I was able to control myself and be disciplined enough not to have those major blowout days. So going on here to the next slide. So successful trading, it's not about being right 100% of the time. It's about learning to cut your losses when you're wrong, right? I only get in setups that I think are going to go, but inevitably I'm going to be wrong some of the time. I'm going to see something, I'm going to think this is a bullish setup, it's going to break out here, and sometimes it won't, right? My percentage of success is 65, 70%, and that's really good for me, and I'm really proud of that statistic, that number. But it still means I'm wrong a lot. So part of learning to be a good day trader is learning to be wrong and have it not be a big deal. Okay, so imagine if all your losses were only $10, okay, but your winners are $90, right? You don't need to be right that often to cover those losses. And using a profit loss ratio like that, if you're right just 10, if you have a good profit loss ratio, and I don't expect you to have a 10-to-1 profit loss ratio. I mean, that's that would be pretty difficult to maintain. But the point is, if we focus on risk management even more than choosing the right stocks, I'm helping you gain the tools to survive in the market while you continue to learn better strategies and how to get the really good setups. Getting to the point where you can achieve 60 to 70% success is something that takes months and probably years for most traders, right? It definitely took that long for me. So I don't expect you to be at that percentage of success right away, but I want to set you up so you can make money even if you're only right half the time. Okay, so choosing stocks on the one hand versus managing risk, right? I want everyone trading strong stocks, But since you can make money with a really bad percentage of success as long as you're managing risk, uh, it's okay if you're still not really good at identifying what is a strong stock or what is a strong pattern. It's more important that every single trade you take has a good profit loss ratio. That what you're risking is not is half of what you're potentially going to make on a winning trade. That's a 2-to-1 profit loss ratio. Okay, so we'll apply the fundamentals of risk management to proper stock selection and chart patterns when we go over those in the next classes. But for right now, just understand that the most important thing is managing your risk. Okay, so when I was a new trader, and this is probably going to sound familiar, I would take trades and I would have no stop. I would just buy 5,000 shares, 10,000 shares, and I didn't really know where I was going to stop out. Okay, this was really risky. But I had a $30,000 account. I had $120,000 of buying power, and I could take 10,000 share positions. Right? I had more power and more money than knowledge, and that was a really risky thing for me, and it's why I lost so much money in my first year. So, for instance, I would buy a stock, let's say at 9.90, thinking I'm going to sell this up at $10, get a nice little pop up to 10, maybe 10.05. But then it would go up to 9.94. It would pause there, and then all of a sudden it would drop down to 9.80, 9.70. And I'm thinking that, well, maybe I'll just hold this. I'll set my stop at, let's say 9.50. Right? If it breaks 9.50, then I'm really going to have to just bail out. Okay, it breaks 9.50, and then I get slippage, get filled at 9.40, and I lose 50 cents. Okay, so just took a 50-cent loss, right? And did I have the potential to make $1? And this is $1 averaging out, right? You sell half when you're up a little bit, sell another quarter when you're up a little bit more. So to get an average profit of $1, I mean, that's a really huge winner. There was no way that stock was going to go to 10.90. Okay, so what I should have done is recognizing that my target was only 10 cents of profit, I should have just had a 5-cent stop. So using a proper stop of 5 cents, that's 10% of 50 cents, right? So I could have been risking 10% of what I actually risked if I was just using a good profit loss ratio. But I didn't understand that at the time. I just thought, well, it still looks good. I don't want to blow out of this. But in reality, I should have. Because say I had 1,000 shares. Take the $50 loss and move on, right? It's easy to recover from $50 losses. It's harder to recover from $500 losses, $1,000 losses, $5,000 losses, right? When you start taking big size and then adjusting your risk parameter mid-trade to accommodate this losing position, you can really get into a bad situation. And that's what would usually happen to me. I would get in this at 9.90, I'd maybe take 5,000 shares, I would be in way too heavy. And I would think, oh, it's going to break, $10. I'm going to sell this at 10.05, $10, whatever. I'll make $700, whatever, $1,500, something like that. But then when it just pauses there at, 9.88 by 9.93, and you're thinking, well, do I want to take the 2-cent loss? Are there even enough shares on the bid if I try to mark it out, or am I going to get a bunch of slippage? And you just kind of wait there. But while you're waiting, the smarter traders are identifying this is weakness, right? This pause in buying while you're thinking about what to do is a sign of weakness, right? The buyers aren't there. This is a problem. The smarter traders are going to get out. So now it's going to be 980 by 90, right? It's starting to come in a little bit. You're still watching it. Now you're thinking, well, maybe I'll just hold this. What's the chart tell me? And now you start looking at the chart, looking for a good area of support, and before you know it, you're drawing your stop at, a 50-cent loss, even though you never went into the trade thinking you were going to risk $2,500 on 5,000 shares. You thought, you're going to risk maybe 200, right? And that's how quickly it can happen. Suddenly you're down a ton. So if you've been in that position, I certainly have. If you've been in that position, you know how it feels. You know how frustrating it is to see a stock just dropping. You feel like a deer in the headlights just watching it drop in front of you. And the important thing to recognize is that there was an error in that process with risk management. Okay? But this is one of the areas that we can improve skill, right? We can get better at managing our risk over time. The more we trade, the more we see these patterns and these setups, we recognize, you know what? This is something I should just bail out of, take the 2 cents of profit or the 5 cents of a loss, whatever it is, just get out. This no longer looks good. Or remember that, look, I went into this with a 2-to-1 profit loss ratio. That means I have to sell if I'm down 20 cents, and that's that. No negotiating. Okay, so this gets into the concept of always know what you stand to lose. So if you don't know how much you're risking in a trade, you're asking for trouble. And anytime you get in something with 10,000 shares, 15,000 shares, most likely you're not thinking about what you stand to lose, right? Because when you're in something with 15,000 shares and it does drop 30 cents and you're down 4,500 bucks, I doubt that you went into that trade thinking you were risking 4,500 to make a potential 9,000. If you were, then you had the right profit loss ratio. And if you're trading at 50% success, then you'll make money trading like that. Even though you're trading with monster size, you'll make money. But if you didn't have a $9,000 profit target, you definitely shouldn't be risking 4,500 bucks. So, and this kind of gets to another point that when I was a new trader, there were times where I would take these $5,000 losses and I would look back at the chart and I would think, man, if I was going to take a stab on something and risk $5,000, it should have been because I had the potential to make 10,000, right? But I risked $5,000 on this stupid stock buying it at $9.90, and my profit potential on it was only 1,000. That's pathetic, right? Why would I risk $5,000 to make 1,000? I'm never going to succeed as a trader if I keep doing this. And I was able to recognize that, but it was, not after. It was after losing probably $50,000 in those types of just really, really stupid trades. It was just a painful process. So my recommendation is that you ask yourself before you get in a trade how much you stand to lose. And remember that sometimes the best trade you take, the best trade is the trade that you don't take. All right? There are times where it's just best to sit on the sidelines. And I know it's hard when you see stocks running up, but the reality is sometimes it's better just to sit on your hands and not take trades. If you can't manage your risk, if you can't get that good profit loss ratio, you shouldn't take the trade. Wait for another one, right? Wait till tomorrow morning. The easiest trading is 9:30 to 10 a.m. for me. That's when I make the most money in the first half hour of the day. And so if I haven't had a really good first half hour of the day, I know odds are, the best time for me to make some really good trades is going to be the next day, tomorrow, right? This morning was okay. I had some good trades in the opening range, but it wasn't anything crazy. And, what are the odds that I was going to hit a $2,000 winner in the afternoon? Statistically, I make the majority of my profits in the morning. So trying to get really aggressive and go heavy in the afternoon and, mismanage my risk is a recipe for disaster. So, when that's the situation, it's better just sit on your hands and not trade. Take the afternoon off. You have to set stops on yourself, where you realize, look, I'm able to maintain my composure really well from 9:30 until 11:30, and then around lunchtime I just start getting sloppy, I get lazy, the market's not trading as well, it's choppier, I start getting frustrated. The ability to be disciplined, it's a muscle that you strengthen. So over time, you might be able to sit in the market from 9:30 until 4, but as you're building that ability to be, really disciplined and maintain your composure when you're stressed out, you may not be able to last the full day. You may only be able to stay at that level of focus for an hour before you need a half-hour break or an hour break, and that's okay. Build up that strength. Just like you're, building up your strength at the gym or anything else, just slowly build it up. Don't try to sit from 9:30 to 4 o'clock every single day. That's going to be too hard for most new traders. Okay, so the question here in chat is, at the open, everything is so fast, so how do I estimate my risk quickly? Right, and this is a really good question. And we were talking about this a little bit yesterday, that one of the things that can be really hard with day trading is that we have to make decisions so quickly. In a matter of 2 minutes, we could be up or down thousands of dollars. So we have to be able to make decisions very quickly. Um, at the open, I have a couple of different techniques for managing risk, and we'll get into this, some of my actual strategies a little later in the class. But for right now, I'll just give you the simple answer, which is that I have to set a hard stop. Okay, and it's not a live stop that's in the system. It's just for me, it's a mental stop that this is my max pain. This is how far I'll let this go before I bail out. So for me, usually it's going to be 20 cents. If I'm down more than 20 cents on most trades that I'm taking, and even if it's a $90 stock like Gilead today, um, you know, at the point where I was down 25 cents, I mean, it just really wasn't looking that great anymore. So for me, 20 cents is usually a good place to just let it go. I may have mistimed my entry. Maybe I got in a little too early or I chased it a little too high up. If I let it go more than 20 cents, if I let it go to 30 cents, 40 cents, I start really stretching out my loss and making it so the odds of me coming out with a good profit loss ratio on the trade just get lower and lower. So on the one hand, I would say a 20-cent stop is good. On the other hand, if you're looking at the chart and you see, look, there's a really good level of support and it's 35 cents away, then you could say, all right, I'm going to buy this out of the gates at the open. My stop is 30 cents away. I'm going to have to size accordingly. Right? If I only want to risk $200 a trade, I can't take 5,000 shares, right? I've got a 30-cent stop. I've got to take, 500 or 1,000. You just have to go a little bit smaller. Okay. Now, if you're looking at a stock that has a 40-cent spread, I mean, in that type of situation, honestly, I probably wouldn't trade it out of the gates because those spreads are going to be really hard to combat. I mean, if you're on the right side of them and it's squeezing up, and you're selling on the offer, I mean, you can do well, but it can go the opposite direction pretty quickly, and you don't want to get caught, in that type of stock going the wrong way. So I would sort of avoid those super big spread type of stocks right at the open. Typically those are going to be stocks that have very light volume. Something that only has 50,000 shares at 940. I mean, I'm not going to take that trade. I mean, I'm looking for something that has usually 100,000 shares of pre-market volume, 200,000, 300,000, the more the better. So if we don't have good volume right out of the gates, it's already probably not going to be the type of stock I would typically trade. But with that said, if you're managing your risk properly, then you could take stocks that are a little outside what I might consider the right stock. You're going to have a bigger cushion to make mistakes. So I would just say that if you see something with a really big spread, to be a little more cautious, because when you're estimating your risk on a stock that is spready, it can be a little difficult, especially if it drops quickly. So if something has a 10-cent spread, it's 15 by 15.10, and I get in at 15.10, I'd probably still have my stop at 14.90, which is a 20-cent stop. Even though you've got a 10-cent spread, it only has to drop a few cents to take you out. But realistically, 20, 25 cents is probably going to be my stop. Now, it's an arbitrary stop, but the reason I use an arbitrary stop sometimes is simply to create a limit to how much I'm willing to lose. Right? Now, I want to cap my losses. I don't want to cap my winners. So I don't put an automatic sell whenever I'm up 10 cents. Right? I don't want to cap my winners, but I do want to cap my losers. So losses at 10 cents to 20 cents makes sense because that's going to be, $400, $800 depending on how much size I have. So that for me is within my risk parameters, for me being comfortable. So that's why I choose 20 cents. And if you feel like that's a little too tight for the stock you're looking at, then you just have to size down a little bit. Okay, so I've talked a little bit about profit loss ratios. All right, so what is a profit loss ratio? It's simply what you make on average versus what you lose on average. Okay, so if your winners on average are 50 cents, Your winners and your losers on average are 25 cents. You've got a 2-to-1 profit loss ratio. Your winners are double your losers. Okay, that's the type of profit loss ratio that I want to see you trading with, a 2-to-1 profit loss ratio. 3-to-1 is good. It's hard to achieve a 3-to-1 profit loss ratio. You're risking 10 cents to make 30, 15 cents to make 45. I find that hard. I don't usually get a 3-to-1 profit loss ratio, and there's two reasons. One reason, a lot of times I don't get a stock that makes such a clean move that I can get a 30 cent or a 40 cent or a 50 cent pop without scaling out. Usually when I'm up, 15, 20 cents, I might put half of my position out on the offer to try to sell a little bit and adjust my stop to break even. That's a technique that I use a lot. Get myself in the driver's seat as quickly as possible, sell a little bit, adjust my stop to break even. Okay, so because I scale out, it makes it hard for me to get 3-to-1 ratios, and then secondly, because of the fact that I'm not usually finding stocks that make really quick moves, it just makes it hard to get that 3-to-1. So realistically, most of our students are trading on a 1-to-1, 1 to 1.5 ratio when it's all said and done. Some of you guys have managed to trade at a 2-to-1 ratio consistently, and I think that's awesome. For me, scaling out is a way of paying myself when I'm right. So if a stock goes up 20 cents, for me, that tells me that I was right. I had the right idea. We were in Herbalife today and it popped up 35 cents on us. That was a really nice move. And I want to pay myself for that. Okay, so I want to sell half and adjust my stop to break even. So when you look at my profit loss and you look at all my trades, I've got lots of small winners, lots of small losers, and then occasionally I'll have a really nice big winner, right? But I don't usually have, I never have $10,000 winners. I don't have trades like that because I'm not going in super heavy and holding the whole position until I get an exit indicator. I'm not a home run type of trader. It's not like I get in a trade and it's either going to stop me out minus 1,000 or it's going to be a $3,000 winner, and it's not going to be anything in between. It's one or the other. I don't trade like that. If I have 5,000 shares and I'm up 30 cents, 1,500 bucks, I'm going to take some profit. Now, if it ends up running 50 cents or 65 cents, you can always say in hindsight, I should have held the whole thing. But how many times you've been up 20 cents and it went back down to even or to a 20-cent loss, right? How much is that? That for me is just really painful to be up $1,500 and then all of a sudden be down $750. For me, that gets me flustered. It frustrates me. So I start taking profit and adjust my stop to break even. That for me is a form of risk management, but it's also a way for me to help keep my emotions in check. Because I know from myself, I know that when I'm up a couple $1,000s and I give it back, I get really frustrated. And I don't want to be in a position where I'm trading out of frustration or anger, so I do what I can to avoid it. And one way for me is just to scale out of my winners, take some profit. Because look, if something goes up 30 cents, you sell half of it, you book $150, whatever, and it goes back and you stop out the rest, break even, well, you still got that $150. You've still got a winner. So small winners, small losers, and occasionally you'll get in that trade that just goes perfectly. You get that 40, 50 cent move. It's a very clean winner. And you get a few winners, big winners. And inevitably there's going to be some losses that are a little bit bigger than you wanted. But if you're using good risk management, those are hopefully going to be pretty few and far between. Okay, so now the stats on profit loss ratios, if you have a 2-to-1 profit loss ratio, 33% success is your break even point. Okay, a 1-to-1 profit loss ratio, 50%. And then a 1-to-2 profit loss ratio, which is a negative profit loss ratio. It means you make $20, but every time when you win, but you're risking $40, right? So your losers are bigger than your winners. So with a 1-to-2 profit loss ratio, 66% is your break even. Okay, so obviously, if you can be at a 2-to-1 profit loss ratio or a 3-to-1 profit loss ratio, you're really putting the odds in your favor. I mean, you can see how dramatically that changes the outlook and the potential for you as a trader. So if you're only making 10 cents on average, but you're losing 20 cents on your losers, you've got to be right 66% of the time just to break even. That makes it really, really hard to succeed. So the best thing you can do is only take trades where you can get a tight stop and you know you're risking half what you're potentially going to make if this winner works out. That's putting the statistics in your favor. Okay? So that means you have to know your stats, right? You have to know how good you are. You need to know your percentage of success. What is your average winning rate? What is your average loss? Right? You want to always aim to improve this ratio because even these small adjustments, you know, an extra penny here, an extra penny there, they can amount to really big dollar and percentage differences. Okay, so knowing your statistics is really important, and that's why I encourage everyone to track your trades on an Excel doc. That way you can sort the data and look at your results. Okay, so we'll just take a quick break here and look at an Excel doc. Okay, so this is the Excel doc that we have on the website. It's very simple. All right, all you have to do is enter your trades. And then once you've got a body of trades here of the data, you can start sorting and tracking that information. Okay, so I've got a couple columns here, gap and go, the gap and go strategy, surging momentum, okay, the surging scanner stocks, first flag, second flag, third flag. We know the first and the second are the best. Third flags and anything beyond that are going to be weaker. And you're going to notice that in your percentage of success. You're going to have a higher percentage in the first and second and lower in the third. And just by having to mark that you took a trade on the third flag is kind of like, I shouldn't have done it, but I did it and I lost, and it's no surprise. So just having to mark that down as a reminder that, you know what, this is going to be the third flag. Should I really take the trade? Maybe not. News trades, top reversal, bottom reversal, and all I do is I just put a 1. I just put a 1 right there. So first flag on a news trade, time of day, I just do it AM or PM. You can do AM, mid-morning, or afternoon, whatever. Source, streaming news. Okay, now here, CSIQ, long, 2,000 shares, 28.77, and the sale was 28.87. Okay, and when you got in at 28.77, what was your stop? 28.49. Let's just say it was 28.49. Okay, just below the $0.50. So you're risking $560. And then what I like to do is write down my max gain. So how much was I up unrealized in this trade, right? If I was up $1,500 in this trade and then I ended up closing it with $200 gain, that's kind of good to know. If you were down 5,500 or 5,900 in this trade and then you closed it for a $200 gain, that's good to know, right? Just track that information and then you can find out how much on average you're down on trades and how much on average you're up on trades unrealized. Okay. So then once you've got this information, what you do is just highlight all these rows, go to data, go to sort, and you can sort by column. Okay, so let's say I want to sort by the first flag. Okay, so you go to G, sort by column G, and all of them will be up at the top. And then you can look at them. Now we've only got one right here. This is just the sample template. Okay, but you'll be able to look at it and then you'll be able to scroll down and be like, oh, all right, I made $2,000 on, first flag breakouts. Okay, my average win rate, you select all these columns and right down here it tells you the average. Average win rate's 20 cents. Okay, that's good to know. Average loss rate, well, these were all winners, so let's put a loss in here. 45.45. Okay, average loss, 22 cents. Okay, so this just gives you this quick picture. Okay, my average winners is 27 cents. My average loser is 22. So that's a positive profit loss ratio, just a little bit better than 1-to-1. All right, your percentage of success, you can go over here to the winners, Select these, you've got a percentage of success of 66%. Okay, and there may be other programs that are more streamlined for tracking your trades, but this works well for me. You guys can use this document. Um, if you're shorting, you can short stocks here as well. You can type it in for short. So I find it really helpful. I do have Excel open during the trading day, so after I complete a trade, I go in and I put it in there. It's a little time consuming. It's a little bit of a pain, but it's worth doing it. Okay, so and I don't track my scaling out. I just track my average buy and my average sale. So if I scaled out, well, still my average win on 2,000 shares was only 10 cents, right? If I sold half of it for 10 cents, another half for whatever 30 cents, and then the rest I sold at a loss, my average win is what it is. So this is just an example. So CSIQ, um, if you're risking $560 on it, let's see, on this first trade, you're risking $560 and you only made 200. Obviously, as it finished, this was not a good profit loss ratio. But what you want to do is over in the notes section, you can take a couple notes. You can say, look, this was a flag, it broke out, it looked like it was good, and then there was light volume, I had to bail on it. So, okay, you took the profit, you walked away from it. You thought it had the potential. You want to make sure that it at least had the potential to go up $1. Now, realistically, like I said, getting that full dollar is not likely. And when you see this is your stop amount, you can type this up before you get in the trade. You can type this and say, okay, well, my stop is 28.49, so maybe I should just take 1,000 shares. Okay, then I'm only risking $280. Or you know what? Maybe I should just take 250 shares because I really don't want to risk more than $100. Okay, so you can adjust this based on how much you're willing to risk. But of course, like I said, when you've got a 50-cent stop, you've got to make $1 to get that good ratio, and that makes it hard. So ideally, you'd want to be able to say, well, I got in this and I was able to put my stop at, 28.60 or something like that. So you're only risking about 17 cents. So what I look at, I don't really look at the net profit loss when I'm looking at my stats. I mean, yeah, I want to see how much I make on a particular strategy or a particular time of day. That is useful to know. But for the most part, I look at my average win as compared to the average loss. So that tells me my profit loss ratio, and then I check my percentage of success. So if I'm trading at 75% success with a 1-to-1 ratio, I'm going to be okay with that because I've got a good percentage of success. Obviously, I prefer to boost up my ratio to 2-to-1, but if I found a strategy where I'm trading at 70% success, that's pretty good. So I might just go with it for the time being and just do what I can to try to improve the profit loss, maybe minimize my losses or try to scale out my winners a little bit better. So you can download this from the website and you can get all of the formulas, and you can do what you want with them, modify them as you'd like. Okay, so I just wanted to show you guys that Excel doc. This for me is probably one of the most valuable things that I have. It's being able to track my data and learn where I'm doing well and where I need improvement. Right now, there might be some reporting you can do from your broker, but you're not going to be able to have the notes of what strategy you're trading, what maybe you'll have the time of day, but this just for me is so much cleaner. It's so much easier. It's the way I've always done it. As I've changed between different brokers and I trade through different accounts, I always have an Excel doc that I track my trades in. Okay, so when you're managing your risk and you want to understand, why you're winning or why you're losing, make sure you've got this document open, because when you spend one-on-one time with me to review your trades, this is the type of thing I'm going to want to see. I'm going to want to know what strategy are you trading the best? What's your profit loss ratio? What's your percentage of success? How much are you losing on average? How much are you winning on average? That's important information. Okay? All right, um, so target profit loss ratios. So like I said, I aim for a 2-to-1 ratio. I want to have the potential to double what I'm risking on any trade. If I'm going to risk $10,000, I want the potential to make 20. It doesn't matter if it's $10,000 or $100. You want to be able to double what you're risking. That is a scalable and sustainable strategy. So if there's a time where you are able to take $10,000 of risk, it's because you knew you had the potential to make $20,000. Okay. Now, there are times where I'm going to sell sooner. I'm going to take what's going to just be a 5 cent or a 10-cent winner, and it's not going to be as much as I wanted. But if I got an exit indicator, I have to bail out. Whether it's a win or a loss, sometimes we get an exit indicator and we've just got to get out. So that's fine, right? But you got in the trade knowing it had the potential for that 2-to-1 profit loss ratio. So in the trading plan that we'll go over in a couple weeks, I'm going to have you aiming for 2-to-1, but we're going to run the calculations expecting that you only hit 1.5 to 1. Okay, and you could see how the percentage of success, the break-even points between 1-to-1 and 2-to-1 are so big that 1.5 to 1, you'll still have room, you'll still have the cushion, but it's just trying to be a little bit more realistic because a lot of times we are going to take profit sooner. Now that's a strategy that works really well for me, both psychologically and financially. So, that's the way I teach it. Okay, but 2-to-1, the golden ratio. So never take a trade that doesn't give you the opportunity to double what you're risking. So you always have to ask yourself, what's my stop and how much am I risking on this trade? You have to know how much you're putting in before you hit the buy order, right? Are you risking $5,000? Is this going to be the day where you have a blowout? Right? Or are you risking 50? That's fine. Risk $50 to make 100. Risk 500 to make 1,000. But always make sure you're managing your risk properly. Okay, so when we have a bigger window of potential profit, you have a better opportunity of capturing a winner, right? So if your profit potential on a stock is only 10 cents, you've only got a 10-cent window. Whereas if your profit potential is 50 cents or 60 cents, then even if you only get 30 cents, you only got half of the potential profit, you still got a nice profit, right? So we want to look for those bigger windows, those bigger opportunities. And that's why I focus so much on the gap and go strategy, because a lot of these stocks gapping up with momentum, with a catalyst, can make huge moves, 10, 15, 20% moves in half an hour. Right, so that gives us a big window of potential profit. And we're not going to capture all of it, right? We're not always going to be able to guess the top and the bottom of these moves, but we have a better opportunity of catching a big winner than if we're just trading choppy sideways markets where we're just aiming for 10 cents, right? So we want to set our sights on some of the bigger potential winners. It's not that we're looking for a home run, but we want to trade stocks that have the potential to be big winners. Right? If it doesn't even have the potential to be a big winner, then why are we going to take our risk on it? Maybe it's better just to sit it out. Now, when we talk about risk in the market, at a certain point you have to ask yourself, what type of trader are you? Right? Because there are some traders that would prefer to trade on 5-minute, 15-minute charts, 30-minute charts that want to go a little bit, a little more slowly with their trades. And there's other traders like me that like to use the 1-minute and the 5-minute and move in and out very quickly with larger positions. So if you're a scalper and you're taking, 3 cents profit, 5 cents profit, typically you're going to have a negative profit loss ratio. Because realistically, if you're taking 3 or 4 cents profit on your winners, it's hard to keep your losers under 5 cents. It happens. You get a 10-cent, 15-cent loss. So if you've got a negative profit loss ratio because you're scalping, you're going to have to be right 70% of the time. So on the one hand, scalping might seem like a quick way to make money because, how often are we up 5 cents? We're up 5 cents all the time. But it doesn't cover the losses, right? Having 5 cents as your average winner isn't going to cover the losses for you to be right only 50% of the time. You're going to have to be right 70% of the time to keep up with that type of profit loss ratio. So that's why it's really hard to scalp. Even though it seems easy because the winner is there, it's actually hard to maintain that type of strategy. But at the end of the day, you have to decide what type of trader you are. And it's just going to be recognizing where you feel most comfortable in the market. So you can apply the strategies that we're going to learn in the next few weeks. You can apply them to 5-minute charts, 15-minute charts, 30-minute charts. The chart patterns are going to remain the same. Okay, it's just going to be what time frame are you going to apply them to. And the strategies, for the most part, again, are going to remain the same. You can apply them to different time frames. So you just want to go with whatever suits you best. But stretching out the time frames to 5-minute and 15-minute charts, 30-minute charts, typically you're going to be less of a scalper and more of a mid-term, longer-term, trend-based day trader. And that gives you a little bit more of a cushion. Trades are moving a little bit more slowly. You might be able to take a few of them at a time. So that could be a good approach, especially for beginner traders. All right, now I also want to talk a little bit about balancing your risk. And this is an area where I needed help when I was a new trader. Say you take 10 trades and you're risking $100 on 9 of them. Okay? But then you go on the 10th trade and you risk $10,000. Does it matter that you won on the first 9 and you have a 90% success rate? Right? It doesn't. Say you even made $1,800 on the first 9 and you were trading on a 2-to-1 profit-loss ratio, but then on the 10th trade you lost 10 grand. Doesn't matter. Right? So it's okay to adjust your size based on feeling, good or a little uncertain about the market or about a particular trade, but you want to balance your risk at least relatively between trades. So you want to risk 200 to 400, 500 to 700, but you don't want to have one trade where you risk 5,000 and another where you're risking 200. Because then when you have winners on all those $200 trades, they're not going to cover that $5,000 loss. Okay, so it's important to balance your risk. And by balancing your risk, you also become detached from the emotions of every trade, right? You don't get emotionally attached to any particular trade because it's just another trade, right? It's just $50, $100. Who cares? This isn't the trade that your whole career is hinged on. It's not this trade that has the potential to, turn everything around. We don't take trades like that, right? I don't have days where I make $100,000. That's just not the type of trader that I am. But I also don't have days where I lose 100,000 or 200,000, right? Just small, steady gains day after day. That's my goal. That works for me. It makes me feel good. Okay, so gambling can be a problem for some traders, right? And gamblers think about profits, whereas traders, successful traders, are thinking about risk. They're asking themselves, what's my stop? They have a mental stop. They know how much they're risking in each trade. And if you're going to take 17,000 shares and risk 10 cents, $1,700, it's because you had the potential to make 20 cents, $3,400, right? So this is just really important to understand. It can be tempting at times to get into this kind of gambling mindset where you start getting really, really aggressive. But if you start to feel that way, you need to get up and walk away. Take a break from trading for the rest of the day. Just walk away. Let that $500 loss or whatever it is that's getting you frustrated, just let it be what it is. Show that you're stronger than that urge to be really aggressive. Okay? It's really important. So, when it comes to risk management and day trading, you're going to have to learn to be good at being wrong. And if you don't like being wrong, this could be kind of a hard job because I'm wrong 40% of the time and I still make money. So, when I first started trading, I didn't like being wrong. And I don't like being wrong, but I'm wrong every single day. Every single day I do something wrong. And, maybe saying it's wrong is not the right thing. If I take a loss, if I think a trade's going to go up and it goes down, am I wrong? Did I make a mistake? It's just the way it is. You just have to learn to cut that loss. When you're down $200 and you cut that loss, that's the right thing to do. Even though it's a loser and, it's going to show on your percentage of success that you were wrong on that trade, it was the right thing to do to cut the loss. You have to learn to be good at that. Okay, take lots of small losses. Get comfortable taking 5, 10 cent losses and just walking away. Brush it off. It's no big deal. It's easy to recover from small losses. You never know when you have a big trade coming just around the corner, right? But you don't want that next big winner to have to make up for stupid mistakes that you made. When I get a really nice news trade on Gilead or NPSP and I make a quick $500, I don't want it to be making up for a trade that I held way too long and took a big loss on. I want it to be putting money in my pocket. I want it to be profitable, right? So learn to be good at just walking away. If a setup doesn't feel right, get out. That's okay. There's a lot of times where I sell flat or for a $20 loss or a $20 gain because I'm just not feeling it. And that's okay. We have enough setups that go almost immediately and have a very clean resolution that if I get in something and it's not looking quite right, I'm just going to get out. But you know what? I'm going to be one of the first people to bail out. You never want to be rushing to the door with everyone else because you're going to get trampled. You're going to get a bad order. You're going to get horrible fills, bad slippage. So if something doesn't feel right, just walk away. Be the first to step back. Say, look, you know what? I'm just going to step back. And if it runs without you, so what? You were managing your risk. You were taking precautions to manage your risk. You were doing everything you could to survive in the market while you continue to learn. Okay, so, you're up $100 today instead of $1,000. Whatever. Green is good. You're up. That's good. Or you're down only 100 instead of 2,000. That's good, right? That's an accomplishment. Especially with a day like yesterday where the market was so bad, anyone that got away without being totally destroyed is, doing something right. Okay, so these are all rules that I have in place to help me reduce my risk, right? Trading is risky. We know that, but we have to manage our risk. Okay, so when I talk about risk, there's really 5 types that we can look at. One is the exposure risk. So that's just how much money you have in the trade. All right, so if I buy 10,000 shares of a $5 stock, I've got $50,000 on the line. Right, that's my exposure. I mean, that's kind of like that's my money that's in the trade. But realistically, where we usually take our losses is just between where we buy and where we sell. Right, so the second level of risk is the distance between your entry and your stop. And then you're going to multiply that by your share size. Okay, that's the risk that we're going to talk about most of the time. How much are you risking on this trade? Don't tell me $50,000 because you've got 50,000 in the trade. If you have a 10-cent stop and you've got 10,000 shares, you're risking $1,000. Right? That's the risk that I'm almost always going to be thinking about. What's your stop? That's how much you're risking. Okay, now we also have slippage. And slippage is when you go and hit the sell button and instead of getting filled at 980, you get filled at 975. So that 5 cents, that's a little bit of slippage. There are some stocks where slippage is going to be a bigger problem than others. All right, so we'll learn that as we go over stock selection, but just know that there is such a thing as slippage and it can be a little bit of a problem. Okay, so we do have to be a little careful on that. Fourth is the float and the volatility. So stocks that have a low float are going to be more volatile. Now, what is the float? The float is the number of outstanding shares available to trade on the market. Okay, so a stock that has very few outstanding shares has very little supply. So if there's a lot of demand, that stock is going to go crazy. All right, it'll go up very, very quickly, but it can go down just as quickly. So low float stocks can be a lot of fun. They can be quick to trade, but that low float makes them more volatile and potentially riskier. So it's just good to know the float of the stock that you're trading. That's a way of measuring the risk. Okay, and then the fifth element of risk is just the time in the trade, right? So, and this kind of comes into the exposure. If you're holding $50,000 worth of stock for 8 hours, or 8 days or whatever it is, there's a certain amount of risk involved. There's always the potential of, something bad happening, news coming out, an SEC halts. There's just that potential. And the longer you hold a stock, the more you're exposed to that potential. So these are the types of risk that I'm looking at and that I'm thinking about when I'm preparing my my day and looking at my watch list. Right? But typically, my focus is going to be, all right, I'm getting in this stock at 9:32. in the morning and it's going to be, I'm going to buy it at $5. Where am I going to sell it if it doesn't go in my favor? 4.80, 20 cents, right? That's what I'm going to focus on most of the time. Okay, and will I have slippage on this particular stock? I will. So instead of taking 2,000 or 3,000, I'm just going to take 1,000 or 1,500. I'm going to go a little lighter. Okay. Now, there's a lot of traders that average down. And averaging down is when you buy something at $5 and it drops to $4, and you go and buy another 2,000 shares at $4 because that brings your cost average down, right? 2,000 shares at 5 and 2,000 shares at 4, your average is 450. So there are traders that will average down if a stock goes against them. I try to just bail out, right? If it goes down 20 cents, I just get out. I don't want to get in the situation where I'm having to average down and work my way out of a losing position. It's time consuming, it's distracting, it's taking my attention and focusing it on getting out of a bad situation instead of finding the next winning trade. If a stock dropped down 50 cents or a dollar, it's immediately something that I'm not happy about. So it's not a stock that I probably want to be trading because of what it just did to me. So the best thing to do for me is just to walk away. Take the loss and walk away. Occasionally, and I mean occasionally, like once every couple of months, I'll get into a situation where I decide to average down. But it's very, very rare. And all of the traders that have been with me for a while know that I almost never average down. If something doesn't look right, I get out. I take lots of small losses, but I don't usually get into a situation where I'm looking at a really massive loss because it dropped a lot and I averaged down and then it dropped more, right? Because when you add another 2,000 shares when it's down at $4 and then it drops to 350, you're adding another $1,000 onto that loss, which was all you're making a bad situation worse. It was already a bad situation, you just made it a lot worse. Okay, so if the pattern isn't working, if the market's not going in your favor, the best thing to do is just get out. Okay, so now a lot of new traders struggle with selling their winners too soon and holding their losers too long, right? And that's when you get into a negative profit-loss ratio. Your winners, you sold them all for 5, 10 cents profit, but your losers, you held to 20, 30 cents. So the real thing here is set your stop and follow it. Don't allow yourself to take those really big losses. Set the stop and follow it. And if you need to come up with a system of punishment for when you break one of your rules, then that's what you have to do. When I was a new trader, I said, okay, every time you make a mistake, you've got to do 10 pull-ups. And I was like, all right, I'm either going to be in amazing shape and totally broke, or I'm going to be in horrible shape and I'm going to be rich. And, I ended up just being, in between, right? I didn't make huge mistakes. I mean, I did for a while, but, I found myself just in between. But I came up with a system where I really didn't want to do pull-ups. So I just said, well, I guess I better not keep making mistakes. But of course, any type of reward system or punishment system is only going to be as good as the person that's overseeing it. So if you're not good at disciplining yourself and following your rules, then you're probably not going to do the pull-ups when you're supposed to. So whatever works. There's a lot of different techniques you can try to use, but the most important thing, just set your stop and follow it. And with the winners, don't sell if you're up 5 cents, but there's no exit indicator. Why are you selling, right? Why would you sell for 5 cents profit, right? That's not enough to justify the trade. And you got in the trade thinking it could go 30, 40 cents, so you should try to give it a shot. All right, so plan the trade and trade the plan. You've heard it 1,000 times, but it's important. If you intended to scalp, don't turn it into a 5-hour long hold. Right? If you intended a short-term day trade, don't turn it into a swing trade. Don't average down because you weren't planning on doing that. And don't add to a bad chart pattern because who does that, right? Why would you do that? That's a bad idea. Okay, so when we're determining profit targets, we're going to review this more when we look at chart patterns, but we're just going to look for nearby areas of resistance and just use those roughly as potential profit targets. I'm going to look at areas of resistance such as moving averages for bottom bounces, recent highs for a stock that's making new highs, maybe a recent high on the daily chart. Anything that we can find that could be a potential area of resistance, I'm going to look at as, that could be my first profit target. So if my first area of resistance is only 8 cents away, it's probably not worth taking the trade. I want to look for those big pockets where we don't have any resistance for $10. So we're getting into a big window. All right, because those big windows, that's when we can get the short squeezes. That's when we can get big moves. All right, now there are some traders with 7-figure accounts that can basically buy something anywhere, and if it goes up, they make money, and if it goes down, they'll just add more. And if it goes down more, they'll just add more. And if it goes down even more, they'll just add more until eventually it starts to go up. They can just keep averaging down. Right? We've all seen traders that do that, but that's not going to work for most traders unless you have a multi-million-dollar trading account. Right? So, if you're a multi-million-dollar trader, well, I guess you could do that, but even if you had that kind of money, I still don't think it's a good strategy. The best thing to do is just to cut those losses and let them go. Okay, now we will get into how to mitigate risk by trading just the strongest stocks. Right, that's going to be the next thing we talk about, is how to choose the right stocks to day trade. But for now, we'll just leave it at aim for that 2-to-1 profit-loss ratio, and remember to always take your stops. Okay, now one other area of potential risk is when a stock is halted by the SEC. Okay, so this can be a little bit nerve-wracking. If you're in a stock and all of a sudden it's halted, you can't trade it. The stock has been halted for trading. Okay, there's a couple different reasons a stock can get halted. You can get halted pending news. So this is when a stock is just trading totally normal and then all of a sudden it's halted. And you go and you look it up and it says it's halted pending news. And you don't know what the news is. The news could be that the CEO resigned. It could be that they're going to file for bankruptcy. It could be that they've been bought out. We don't know what it is, and there's nothing you can do. The stock is halted. That can be a little bit of a scary situation, and it's one of the reasons I don't really like to hold stocks for a really long period of time, just because that's a potential risk. How often does it happen? I mean, I don't know exactly statistically how often it happens, but we've all seen it happen, and it's just something that you have to be aware of. Okay. Now, a stock halted pending SEC investigation is really bad, but we're not trading penny stocks and we're not trading the pump and dumps, so we really don't have to worry about that too much. Okay. That is something that's really common with the penny stock traders, but that's not our cup of tea, so we don't have to worry about that too much. But what usually happens is the stock will get halted. It'll be halted for a couple weeks, and when it reopens, it's going to be down like 50%. So anyone that's in it is going to get destroyed, basically. Okay, and then there's also a volatility halt. A stock that moves up 10% in 5 minutes will set off a circuit breaker, and the stock is going to be halted for 5 minutes. Okay, that's a volatility halt. It's designed to slow down the volatility in the market. Okay, so a stock drops 10%, it's halted 5 minutes. It'll reopen and then it starts trading again. If it drops another 5%, drops another 10%, it'll be halted again. Okay, so with these volatility halts, they often happen when a stock, all of a sudden there's breaking news, and stocks will be halted pending news if it's released by the company. But if news comes out, say news comes out that, I don't know, the Tesla car caught on fire or something bad like that. It's not going to be maybe released by the company. It's just breaking news, world events that can cause a lot of volatility. So in those situations, we can see stocks that make very quick moves. And as you know, I'm a day trader. I look for volatility. So this can provide a potential for a trade when it reopens. We can take these trades, but they're going to be riskier, and it's basically trading breaking news. And I'll go over my breaking news strategy later in the course, but the potential for a stock to get halted is something to be aware of when you're trading. It will happen from time to time. When you're holding through a halt, if you're I've been in stocks that are halted, and there's nothing you can do except wait for it to reopen. The halts that I've been in have been the 5 minute volatility halt, and when it reopens, the trading comes right back. And usually, if a stock is halted while it's shooting up, it's going to reopen higher and keep going. That's not always the case, but that's what oftentimes happens. The news is good, so the stock is going to keep going up. I've seen stocks that go up 30% and they're halted 3 times on the way up. Halt 1, 2, 3. And you can just hold the whole time, and then when it starts to come in, you just bail out. Now, if you're holding a stock and it was halted and it didn't reopen for 3 days and you were on margin, I suppose your broker would probably call you and try to figure out what to do. I don't really know what they do in that situation because the stock is halted, but you might get a margin call and not be able to trade until it reopens. So, it's just something to be aware of. But for the most part, I'm able to mitigate risk by focusing on strong stocks and by tailoring my trading strategy to avoid being in situations where, I could be holding something and there's a high likelihood of a halt. I don't trade the penny stocks. I don't trade these super, super risky, type of stocks. And I think that's the best thing to do. Okay, so tomorrow we're going to pick up on stock selection, learning how to choose the right stocks, again, to help us reduce our risk as day traders. Okay, so that'll be tomorrow. Anyone that has questions watching the recording, feel free to shoot me an email, ross@daytradewarrior.com. Anyone that has questions now in class, feel free to throw them out there and we'll do some Q&A.